Let's stick with the markets here. We've got a very special guest this morning. Jenny Johnson, President and CEO of Franklin Templeton, which has $1.5 trillion in assets under management. The 76-year-old firm was one of the roughly dozen to launch a spot Bitcoin ETF just last week after the SEC gave the go-ahead. Jenny, great to have you with us here on set.
Thanks for having me.
Let's start off with the Bitcoin ETF. I do want to, of course, get your take on the markets. But in terms of the Bitcoin ETF, we've seen massive inflows. That was expected in the early days. What do you expect as time moves on? And who are the incremental investors in this ETF, in your view?
You know, it's funny. I'm known for saying that Bitcoin's the greatest distraction from one of the greatest disruptions in financial services, which is blockchain. So a lot of people took that as I'm not a believer in Bitcoin. And yet, you know, launching this ETF, you can see, obviously, the demand that's out there for Bitcoin. And I think there's a lot of reasons why that is. I think that, one, from a blockchain standpoint, the ability to pay, Bitcoin's going to be a key component of that. And the technology is going to open up a lot of really interesting types of investment opportunities. We actually launched a tokenized money market fund. We're the first mutual fund first traditional asset manager to actually launch a 40 Act fund on a public blockchain, on the Stellar blockchain. So Bitcoin is just one of the suite of what we think are opportunities here. You know, one of the things that made me a believer is as I went around the world talking to people who would tell you, I had somebody who said, I keep 50% of my savings in Bitcoin because if I say the wrong thing in my country, I could have my assets confiscated. I remember talking to somebody in Israel who said, my parents and their parents had all of their assets confiscated. They keep a portion of it in Bitcoin. So there's a fear component to it that is considered almost a insurance or safety component. But I also think it's really important to fueling what is a next real opportunity in this blockchain world.
Right. So, I mean, the scenarios that you just outlined, that's the case for holding Bitcoin, the actual, you know, you have the keys to the security as opposed to investing in an ETF. Right, so there's a use case for both.
For sure, but that still keeps a floor on the price, right? So it keeps on the floor on the price. And then if you've actually tried to acquire and deal with the keys, it's really complicated. Yeah. Right? I mean, I did it at one point, and then I was trying to actually figure out how to get back in, and it's hard. And so being able to open it up and have access to that through an ETF and just simply through your brokerage account is a much better way to access it.
What's your take, just pivoting back to the markets here, what's your take on what we've seen so far in 2024? And if I told you that the Fed was only going to, you know, cut 2 times as opposed to 6 or whatever the market has priced in right now, does that make a difference to your outlook for the year?
Oh, sure. And I actually think, you know, my view, and I've been saying this for a while, is I think that the market's a little overly exuberant about what they think, how quickly the cuts are going to be. I mean, you just saw the Atlanta Fed come out and say wages are, you know, 5.2%, retail sales higher than people expected. You know, I think there's something like 1.4 jobs available for everyone. That becomes, you know, a floor to inflation. And so I think that the market's been a little bit excited. I don't think we're going to get cuts until the second half of the year. And those cuts are probably 50 to 75 basis points total.
Of the $1.5 trillion you have under management, I'm sorry to put you on a spot like this. How much is in money markets? What are those money markets earning? And how long is it going to stay in money markets? Where does it go next?
So I'm going to ballpark estimate that it's probably 60 to 60 billion with Western Asset Management and Franklin. We have money market funds in 2 places. They're earning like 5.1%.
So not that much in money markets right now. Say.
Well, I don't.
More than it was, but
I don't know. It's still decent, you know, 60 billion. I guess it's all a perspective. But,
right. Where does it go? Do you see that as there's something like, what's the number, Mike? 8 trillion out in the economy?
It's more like 6. Yeah. Well, in terms of savings time deposits.
Right, time deposits.
Yeah.
Is that fuel for the market?
100%. 100%. Well. Is it fuel for the stock market, or is it fuel for also longer duration fixed income?
Either way, right.
And so, yes, you know, cash on the side is always an opportunity. You know, the market obviously, if rates come down, that's a good thing for stocks. But I also think because we've seen this great concentration, I mean, the Magnificent Seven are now 31% of you know, the market cap and have been 70% of the return At the peak of the dot-com boom, that was 26.5%. So we actually have a greater concentration right now. So I actually think where's the opportunity? The opportunity is going to be in other areas, this broadening. Sure, it hasn't happened yet. We're all a little surprised, but I think it's inevitable for it to happen.
And what about in terms of your business, the way you address clients, their preferences? I mean, obviously all the flows, on a net basis have been toward ETFs more than traditional fund structures. Even in, the retirement areas where that's been a difference. But how do you compete in that world?
So, look, our view is, what is our expertise? Our expertise is making active investment decisions, and we will deliver them in any vehicle which our client would like to receive them. So you'll get the same strategy or similar strategy in a mutual fund, an ETF, a separately managed account, a co-investment or a collective investment trust. We're agnostic to how that strategy is delivered. And so ETFs are, obviously, you see it. There's a variety of reasons of why. I think part of that is, as the world's moved fee-based, what used to be kind of servicing fees embedded in mutual funds are now charged at the account level, and that has changed to this big, push into ETFs. People often would talk about ETFs synonymous with passive investing. We're passive mutual funds. And what you now see is actually the ETFs moving much, you're seeing a lot more actively managed ETFs, and that's a space that we're very focused on.